So if you have a 60-40 portfolio today, if you're an investor with a 60-40 portfolio, you're an advisor with clients that have a lot of 60-40, what's the easiest place? What would be like like a baby step where you could add an element of alternative investing without it being a risky proposition?
Well, first
to go to your client.
First and foremost, I'll tell you where the most paramount place is. It's fixed income.
Yeah.
So most advisors today are required by their IPSs to use fixed income. You can't move away from a government bond or a corporate bond too much because of the fact that your compliance departments will tell you. So you need to solve that. So what do you need? You actually need alternative fixed income managers who are going to actually risk manage your fixed income bucket today, because that's your number one priority. People are long significant amount of fixed income in their books that are going to become painful for investors. They're going to either reduce the return or the risk is going to go up. So we need to manage that as a critical first step. And so what you're looking for, you're not looking for a traditional bond manager. You need real managers that understand credit risk, duration risk, are going to be tactical around it. That's what Sandy and our team does a phenomenal job. You need that alternative fixed income manager. So that's one thing. The second thing, and they're doing things like hedging out risk. They're managing rotation against duration. They're doing their credit hedging and all that.
So now, are you saying that you take part of the fixed income sleeve your portfolio and you replace it?
I think we got to move past this idea that passive bond investing is going to be a positive thing. We are at as I said, we moved into a bond bear market. The pendulum, unfortunately, is swinging towards everyone going to bond indexes. I moved away from this. When I started Claymore, I was a bond index, bond ladder guy. I started Purpose with the idea that we can't do that anymore. That was good for the 2000s. It's not good for the new world we're living in. So everything we do is active and alternative active fixed income. So you need to actually replace all your passive bond thinking in more alternative bond thinking. The second area is then when you get into equities. So a nice easy step will be things like, looking at long short hedging strategies. So there's some interesting ways to do that. There's good managers out there. We offer some hedging strategies. But then the other one, which is actually a really interesting thing, is more like put option running strategies. Why? Because when you look at put option, you're using volatility of the stocks that you own to generate your return, instead ignoring what's going on in the markets as a beta. And to us, that's a really powerful stream of return that gives you very low beta. There's simple baby steps. There's simple things you can incorporate. They still give you nice absolute return, but they don't look anything like the S&P 500, and they therefore reduce the volatility and risk of your equity portfolio really meaningfully. So there's some really interesting baby steps investors should be thinking about. The departure then, when you go really far, is in getting into market neutral strategies, absolute return strategies, which are really important and can be quite important to this building of a portfolio today. But you don't need to go all the way there to start this off.